How can credit cards in real estate USA help everyday property investors manage short-term costs without crossing into complex financing tools? On Real Estate Capital and Growth USA, we're exploring how credit cards function inside the American property market, focusing on limits, interest, and payment cycles. This video breaks down the core mechanics behind how these cards operate, giving you a clear picture of how they connect to real-world real estate expenses. Let's begin by understanding the fundamental nature of credit cards before linking them to property-related transactions. Before we begin, we want to let you know that this content is for educational and informational purposes only. It is not financial or legal advice. Always consult a professional before making any decisions. Now, let's start with basics of credit cards in everyday use. In the world of credit cards in Real Estate USA, understanding how revolving credit works in daily life provides the foundation for seeing its role in property-related spending. Across the United States, millions of cardholders rely on credit cards for structured and trackable transactions that blend convenience with accountability. These tools are not complex financial instruments, but simple systems designed for everyday purchases, monthly repayment, and transparent reporting through statements. Each statement cycle summarizes expenses, showing total balances and payment due dates, ensuring clarity in how money moves. This concept sets the stage for exploring how these familiar tools appear in small parts of the real estate process. Let's now explore how they operate in day-to-day use, before connecting them to property transactions later in the video. Everyday function of credit cards. Credit cards function as short-term borrowing tools. A cardholder can make purchases up to a predefined credit limit and repay either the full balance or a portion over time. Lenders calculate monthly statements summarizing purchases, interest, and minimum payments. Across the United States, this system helps track spending while offering flexibility to manage timing between income and expenses. In a real estate context, this structure mirrors the same logic: credit flexibility for immediate needs. Whether it's covering moving costs or short-term property expenses, this revolving nature creates a predictable financial rhythm for American households. How credit cards relate to real estate operations. Within the real estate landscape, credit cards sometimes help manage smaller, time-sensitive payments, such as deposits for home inspections, renovation materials, or contractor fees. These are everyday examples, not investment strategies, and they represent short-term, manageable uses of credit. For instance, a property manager might use a card to buy paint and maintenance supplies for a rental unit before larger funding arrives. This usage illustrates how everyday credit systems integrate into broader financial activities, without replacing primary real estate financing methods. Responsible use and transaction tracking. The key to understanding credit cards in this context is recognizing their structured repayment and reporting system. Statements provide transparency by displaying total spending, minimum due, and due dates. These details are vital in everyday U.S. credit management. For real estate professionals or homeowners, the benefit lies in organization, not profit. Credit card statements offer an overview of cash flow timing, ensuring that operational costs are tracked and reconciled clearly within personal budgets. In summary, credit cards in Real Estate USA operate on simple principles of revolving credit, transparent statements, and repayment flexibility. These systems allow U.S. consumers to handle immediate, smaller-scale expenses with structure and oversight. When applied in a property context, their purpose remains the same: organization and clarity in cash flow management. This video section offers educational insight into how these tools function within the larger financial ecosystem. Credit cards in the U.S. real estate context. In U.S. real estate, credit cards often appear during transitional stages, those short-term, high-activity moments that bridge one phase of a property transaction to the next. From renovation materials in California suburbs to staging purchases in New York apartments, these cards provide temporary flexibility for individuals and small firms managing quick expenses. They do not replace structured lending, but instead serve as manageable, short-term payment tools within the American property ecosystem. Let's now explore how these small tools quietly support real estate momentum across the United States. Property preparation phase. Before listing, many U.S. property owners use credit cards for staging supplies, light renovations, or professional photography. These quick expenses often precede larger financing steps and can keep marketing timelines on schedule. In cities like Dallas, Atlanta, and Phoenix, where real estate turnover is rapid, access to immediate purchasing power helps maintain efficiency. Transaction and closing costs. During property closings, real estate professionals in the USA may temporarily rely on credit cards for administrative or moving-related costs, covering document processing, staging removal, or last-minute service fees. These are operational tools, not investment mechanisms. The focus remains on maintaining transaction flow until final settlement funding is cleared. Real-world scenarios across the U.S. From Florida condos to Texas duplexes, small developers or landlords may cover inspection fees or emergency maintenance with credit cards to avoid workflow delays. Each transaction remains situational and temporary. The key educational insight is understanding how flexible payments support operational continuity in America's fast-paced property landscape. In summary, credit cards in U.S. real estate serve as supporting tools, bridging short gaps between larger financing structures. They simplify logistics, improve transaction fluidity, and enhance time management for both individuals and professionals. It's crucial to remember this discussion remains educational and informational, intended to describe operational behavior in property markets across the United States. Understanding credit limits. In credit cards in real estate USA, understanding credit limits is essential for grasping how temporary financing tools support property-related activities across the United States. A credit limit represents the maximum amount authorized by a card issuer, influenced by general credit profiles, income levels, and repayment histories. In this section, we'll explore how these limits operate in everyday real estate scenarios, their practical applications, and how they help maintain operational flexibility. This foundational insight helps explain the mechanics before moving into the costs associated with carrying balances. Setting credit limits in the U.S. Credit limits are determined by analyzing general financial patterns, historical repayment data, and average income ranges. According to the Consumer Financial Protection Bureau, these limits differ widely across cardholders and regions, reflecting local purchasing behaviors and credit utilization norms. In real estate transactions, such limits can temporarily bridge small gaps, like inspection fees or minor repair materials, without interfering with larger structured loans. Practical use of limits in real estate tasks. Moderate credit utilization ensures continuous access to available credit, which can be crucial when quick, operational expenses arise, such as temporary staging, inspection payments, or repair supplies. These scenarios illustrate credit cards in real estate USA as functional tools, rather than investment strategies. Monitoring and maintaining access. Keeping usage within moderate limits not only preserves credit access, but also provides transparency for record keeping. Across American property markets, from suburban Atlanta to downtown Los Angeles, tracking available credit helps property managers and investors plan small operational expenses efficiently without disrupting overall transaction timelines. Credit limits act as borrowing caps that support short-term property-related expenses in U.S. real estate. Maintaining moderate use ensures continuous access, while providing a clear view of operational flexibility. Understanding this concept allows investors and homeowners to manage small gaps efficiently, always within an educational context. How interest works on credit cards. In credit cards in Real Estate USA, interest represents the cost of borrowing and is an essential concept for understanding how temporary financing tools function within property-related scenarios. Expressed as an annual percentage rate, APR, interest accumulates on unpaid balances and is calculated using the average daily balance multiplied by the daily periodic rate, then compounded over the billing cycle. Across the United States, this general mechanism applies uniformly, from small property repairs in suburban Atlanta to quick supply purchases for Chicago investment units. By understanding how interest works, investors gain a clearer perspective on tracking how expenses evolve throughout a billing period. Let's now explore practical applications of interest in everyday real estate-related uses and how this affects short-term credit planning. Interest calculation mechanics. Interest accrues daily based on the average balance throughout the billing period. For example, if a property owner uses a credit card for minor repairs or staging costs and does not pay the full balance immediately, the interest begins compounding daily. The calculation is standardized and applies to U.S. cardholders universally, providing a transparent view of how carrying balances affects owed amounts over time. Practical applications in real estate. Short-term property-related expenditures, such as inspection fees or minor renovation purchases in U.S. cities like Los Angeles and Miami, demonstrate how interest interacts with revolving credit. These transactions highlight operational flexibility rather than investment advice. By observing the accumulation of interest, people gain insight into the general mechanics of credit cards without needing to implement any personal financial strategies. Tracking and awareness. Understanding interest enables property managers and homeowners to track temporary expenditures efficiently. Across U.S. real estate markets, monitoring APR accumulation helps maintain clarity in short-term financial flows and ensures that credit remains a controlled operational tool rather than a primary investment source. In summary, interest on credit cards in Real Estate USA is the cost of borrowing that accrues over time based on balances and the APR formula. Awareness of this mechanism allows property stakeholders to monitor temporary expenditures, maintain operational clarity, and manage short-term credit efficiently. Payment cycles explained. In credit cards in Real Estate USA, understanding payment cycles is crucial for managing short-term operational expenses in property-related contexts. A payment cycle typically spans 28 to 31 days. After a billing statement closes, a grace period, commonly 21 to 25 days, allows full repayment before interest applies. Minimum payments represent a fraction of the balance and keep the account current. Across the United States, this structure provides predictability for day-to-day property expenses, from escrow-related payments in suburban Chicago to minor repair costs in Miami rental properties. By learning how cycles operate, investors gain insight into timing expenses and reconciling short-term costs effectively. Let's now explore how these cycles align with real estate transactions and why this rhythm matters. Standard payment cycle mechanics. A standard credit card payment cycle in the U.S. establishes a predictable schedule for billing and repayment. After the statement closes, the grace period provides a window where no interest applies if the balance is paid in full. This mechanism is consistent across regions, from New York investment units to Los Angeles rental properties. The predictable schedule ensures that operational expenditures remain manageable without relying on advanced financing strategies. Linking cycles to property expenses. In property-related scenarios, payment cycles often align with key transaction events. Short-term costs like minor renovations, inspection fees, or escrow-related disbursements can be reconciled within these timelines. Observing how minimum payments maintain account status demonstrates the functional, operational aspect of credit cards in Real Estate USA. Monitoring cycles for predictability. Maintaining awareness of billing cycles and grace periods supports operational planning across U.S. real estate markets. From Chicago multifamily rentals to Miami vacation properties, understanding these cycles allows temporary expenses to be scheduled predictably, providing clarity for property managers and investors, without crossing into advanced financing guidance. Payment cycles and credit cards in Real Estate USA provide structured timing for reconciling expenses, supporting short-term property-related operations in cities across the United States. Understanding cycle length, grace periods, and minimum payments gives insight into maintaining operational clarity and timing expenditures. We've explored how credit cards function within U.S. real estate operations. Limits define available borrowing capacity. Interest reflects the cost of carrying balances. Payment cycles set the rhythm for repayment. This overview is designed for educational purposes only and reflects general practices documented by public agencies. Always review your own credit statements for accuracy and understanding. What topic should we explore next in the world of property and finance fundamentals? Comment below and keep learning with Real Estate Capital and Growth USA for more clear, fact-based insights on how everyday tools interact with real estate transactions. Thank you for watching, and don't forget to subscribe to our channel for more content. See you in the next video.